There is a structural threshold in personal finance that most people never identify. A point where accumulated capital begins generating more than earned savings can contribute. Not a number, a dynamic. What the long horizon data shows is not a magic figure that changes everything. It is a shift in the mechanism driving growth, from labor-dependent to capital-dependent, from additive to compounding. Almost nobody frames it this way. That framing is where this analysis begins. The idea of a single transformative financial figure is a cultural artifact, not a financial one. In 1995, $1 million represented substantial real purchasing power. Adjusted for inflation through 2024, that same million in 1995 dollars would require approximately $2.1 million today to carry equivalent weight. The nominal figure doubled. The purchasing power did not. The problem with absolute figures is that they exist in isolation from context. $1 million functions differently for a household with $30,000 in annual expenses than for one spending $120,000 per year. It functions differently in a 3% inflation environment than in a 7% one, and it functions differently held in cash than deployed across diversified, productive assets. Portfolio size in isolation answers an incomplete question. The more structurally useful question is what a given portfolio generates relative to what a given life requires, and whether that ratio is sustainable under realistic return and inflation assumptions. What matters is not the figure, it is the ratio, the relationship between what capital produces and what expenses demand. That ratio is where the analysis becomes precise. There is a point, not a number, a point, when the mechanics of a financial system invert. Before that point, labor is the primary engine. Income is generated, a fraction is saved, and the portfolio grows mainly because contributions keep being added. Growth is largely additive. It tracks the effort applied to it. After that point, accumulated capital assumes the primary role. Returns on the existing base begin to exceed what new savings can contribute. Contributions continue, but they become a secondary factor. The system is generating more than the individual is adding. Consider a concrete example. Someone saving $15,000 per year has accumulated $250,000 in a broadly diversified portfolio. Applying a long-run historical real return assumption of approximately 7%, that portfolio would generate roughly $17,500 in a given year. The capital is now outpacing the savings rate in terms of annual contribution to growth. Not dramatically, not smoothly, not without the distortion of volatile years, but the structural dynamic has shifted. This threshold, what we're calling the systemic replacement point, is not financial independence. It is not retirement readiness. It is a change in the dominant mechanism of growth. The engine transitions from primarily manual, requiring ongoing labor input, to primarily systemic, driven by returns compounding on an established base. Reframing around this dynamic changes what the actual objective is, not a target number, a target ratio, and the capital mass required at plausible return assumptions to make that ratio tip. The long-run data on broad equity market performance provides a useful, if imperfect, framework. U.S. equity indices tracking the broad market have historically produced nominal returns averaging approximately 10% annually over the past century. Adjusted for inflation, the real return has averaged closer to 7%. These figures reflect long-horizon aggregates, not annual guarantees, not decade-specific expectations, and not universally replicable across all markets or time periods. The rule of 72 translates these averages into structural expectations. At 7% real, capital has historically doubled in roughly 10 years. At 5%, a more conservative assumption, approximately 14. These are reference, points, not projections. What the data also shows is the range of variation within those long-run averages. The decade from 2000 to 2010 produced essentially zero nominal returns for the U.S. Broad Market Index, encompassing two significant drawdowns, the dot-com correction and the 2008 financial crisis. Investors who maintained contributions throughout that period were structurally positioned for the recoveries that followed. Those who exited during the drawdowns captured losses without the subsequent rebound. The pattern the historical record supports is not that markets trend upward across any given window. It is that across sufficiently long horizons, 15 to 20 years or more, as the data has historically indicated, broadly diversified equity exposure has tended toward positive real returns, with meaningful variation along the way. Two reference scenarios are worth maintaining in parallel. The historical average case, which supports the structural logic of long-term compounding, and the conservative case, 5 to 6% real, which accounts for extended stagnation, higher than expected inflation, or structurally lower future returns. Planning built only around the average case carries undisclosed risk. The relationship between annual savings and annual capital returns shifts materially as a portfolio scales. At $50,000 in accumulated capital, a 7% historical average return produces approximately $3,500 annually. For someone contributing $15,000 per year, that return is marginal in comparative terms. Contributions are doing the structural work. At $300,000, the same return assumption produces roughly $21,000. Contributions and returns are now approximately comparable. The system is approaching a structural balance point. At $500,000 and beyond, capital returns begin to dominate the growth equation. Contributions remain meaningful, but they have become a secondary driver relative to compounding on the accumulated base. This is the regime shift. Before it, growth tracks inputs. It is a function of effort and discipline. After it, growth is increasingly a function of what already exists and how long it is allowed to compound. The trajectory changes shape. Capital accumulated early participates in the compounding regime for longer. This is not a motivational observation. It is a mechanical one that the mathematics of compounding demonstrate directly. Earlier accumulation, at any level, has a longer runway in which to benefit from the exponential phase. Two structural factors consistently underperform in investor expectations, and both deserve precise treatment. The first is inflation. A 10% nominal return in a 4% inflation environment is a 6% real return. In a 7% inflation environment, that same nominal return becomes 3% real. These are not interchangeable outcomes. An investor oriented toward nominal portfolio value, without accounting for the purchasing power that value represents, may be systematically misreading their actual financial position. In practical terms, real return, the nominal return net of inflation, is the more relevant measure of progress. Nominal growth that fails to outpace inflation represents a decline in real terms, even as the account balance rises. The second factor is sequence of returns risk, the structural impact of the order in which gains and losses occur. Two investors with identical average annual returns over a decade can arrive at substantially different terminal wealth depending on whether large losses fell early or late in the period. A 40% portfolio decline in year one requires approximately a 67% subsequent gain just to recover the original value. The mathematics of loss are asymmetric. The percentage required to recover always exceeds the percentage lost. This asymmetry carries different implications depending on the phase of the investor's timeline. During the accumulation phase, when contributions are ongoing, early market declines are partially offset by the ability to purchase additional units at lower prices. The structural impact, while real, is partially absorbed by continued investment activity. During the distribution phase, when the portfolio is being drawn down rather than built up, the dynamic reverses. Early losses reduce the capital base precisely when withdrawals are compounding against it. Sequence risk has historically been most structurally damaging in this phase because there is no offsetting mechanism of continued contributions. Portfolio architecture that accounts for this distinction, including allocation to lower volatility assets as distribution approaches, reflects a more complete treatment of the risk. There is a layer of financial dynamics that projections rarely model accurately. The relationship between capital accumulation and the quality of financial decision-making. Behavioral finance research documents a consistent pattern across investor populations. Those with smaller portfolios have tended to exhibit higher sensitivity to market movements, more reactive exit during drawdowns, greater susceptibility to performance chasing, and higher anxiety correlated with valuation changes. This is not primarily an education failure. It reflects a rational response to a situation where a 20% portfolio decline represents a material and immediate threat to financial security. As capital scales, the behavioral environment shifts. A 15% drawdown on a $500,000 portfolio represents a different psychological and practical reality than the same drawdown on $50,000, even if the percentage is identical. The investor with the larger base can more plausibly maintain position through volatility without their underlying financial stability being threatened. Loss aversion, the well-documented behavioral tendency for losses to register as roughly twice as significant as equivalent gains, diminishes in practical consequence when the scale of loss no longer produces an immediate constraint on security. The investor who can hold through volatility because their base is large enough to tolerate it structurally, is more likely to participate in the recoveries that the historical record has tended to follow drawdowns. Capital does not just change portfolio figures. It changes the decision-making environment in which financial choices are made. Understanding a structural mechanism and remaining inside it long enough to benefit from it are different things. The early accumulation phase tends to be the most discouraging in absolute terms. A 7% return on $20,000 is $1,400 per year. The mechanism is operating, but the output is small enough that it doesn't register as meaningful. The behavioral pull toward reallocation, withdrawal, or disengagement is highest precisely when the compounding base is too small to produce visible momentum. From that friction, interruptions emerge. Drawdowns prompt liquidation. Lifestyle inflation absorbs income growth before it reaches savings. The absence of emergency reserves converts portfolios into liquid cushions. Each interruption delays or resets progress toward the structural threshold. Retirement savings data illustrates the outcome. Average balances in employer-sponsored retirement accounts have remained substantially below what long-horizon equity exposure, initiated early and sustained consistently, would historically project. The gap between theoretical and realized accumulation is not primarily explained by market underperformance. The more consistent explanation across the available research is discontinuous participation. Exits during drawdowns, premature withdrawals, extended pauses in contribution, or delayed enrollment. The long-run compounding pattern has historically been robust across extended periods. The behavioral infrastructure required to remain within it long enough for that pattern to produce structurally significant results is, for most investors, the harder problem. What this analysis has established is a structural frame, not a prescription. There is no universal figure that constitutes a meaningful financial threshold. There is a dynamic, a ratio between what a portfolio generates and what an investor saves or spends, that when it crosses a certain proportion, changes the fundamental mechanics of how wealth accumulates. That crossing point occurs at different absolute values for different people, depending on savings rates, expense structures, and the real return environment they operate within. This is also where the question of sufficiency becomes structurally precise. Whether a given portfolio is enough cannot be answered by the figure alone. It depends on the annual withdrawal rate that figure must sustain, the inflation assumptions applied across the distribution period, and the real return the remaining capital is expected to generate throughout that span. A portfolio that supports a 3.5% annual withdrawal rate under conservative return assumptions is structurally different from one drawing at 6%, even if the nominal value is identical. The historical record on broad, diversified, long-horizon equity exposure has shown nominal returns in the 9 to 10% range and real returns of approximately 6 to 7%, with material variation across decades, including extended periods of stagnation and drawdowns of 30 to 50%. These patterns have supported the structural case for compounding as a long-term wealth-building mechanism. They do not determine outcomes for any individual portfolio in any specific period. Inflation has historically functioned as a persistent structural drag, not an episodic one. Volatility has been a consistent feature of equity exposure, not an anomaly. The behavioral response to both, more than the mechanism itself, has tended to be the decisive variable in long-run realized outcomes. The architecture that has historically supported sustained accumulation shares consistent structural features. Automated contributions that reduce friction at the decision point, systematic reinvestment of returns, diversification across asset classes and geographies, and time horizons long enough for the compounding regime to become structurally dominant. Typically, the data suggests this requires a minimum of 15 to 20 years of consistent participation. What emerges from that architecture is not a single event. It is a gradual, probabilistic shift in the dominant driver of portfolio growth, from labor and contribution to compounding on an established base. The goal is not a number, it is a ratio, and the system dynamics that make that ratio self-sustaining. Financial method. We don't sell dreams, we explain systems.